So the big question is this: how are real estate investors who don't have a ton of free time, don't have access to off-market deals, and didn't start life on third base, how do we grow a real estate business conservatively to support our families, finally leave the corporate rat race, and build a legacy? That is the question, and this podcast will give you the answers. I'm Ed Matthews, and this is Real Estate Underground.
Hey everybody, Ed Matthews here with the Real Estate Underground. I am joined by, as always, my Yoda and personal mentor, Mr. Richard Brown. Hello, Richard. How are you, sir?
I'm doing well, Ed. Glad to be back on another podcast, and I'm excited about today's guest.
Me too. Let's introduce him. So Brendan Chisholm, thank you very much for joining us today. We were just commenting offline before we started that it's fascinating that we all run in the exact same circles, buying the exact same properties, and the names are interesting, but we've never actually shared a beer together, a cup of coffee. So this, I guess, is our virtual cup of coffee to get us going. But welcome.
Thank you very much, Ed. Thank you very much, Rich. It's an absolute pleasure to be on the Real Estate Underground, and really comes full circle joining a podcast for the CTV where I started to cut my teeth in real estate.
Yeah. So Brendan, you have a unique background, and I'm curious, can you kind of walk the audience through how you got into real estate and your 9-to-5 job and your 5-to-9 job, as you like to call it?
I graduated from college in 2008, and I'll just go through the entire background.
Yeah,
my whole mantra was work hard and you'll get a good job. The same thing that everybody has been taught, or not everybody, but what I was taught growing up. Get your education, go to school, get that job, get that 401k. Graduated from Syracuse University 2008. Got my first job out of college working at a high-paying job as a field operations manager for DHL. Was in New York City, worked there for 9 months and got laid off. This was in the depths of the great financial crisis in 2008, 2009, right. And tried finding a job, moved back home where I'm from in Massachusetts, finally got a job, and I'm like, okay, let's do this again. Let's continue to grind and figure out a way to do it. Started working for a rental car company as a manager for there. Busted my butt, got multiple promotions within 5 years, and then became a director of fleet operations for them. Moved from Boston down to New York City, and then moved out to Michigan. I think I was 27, 28 at the time, and was there for 15 months. And this was when Detroit was still bankrupt, and nobody wanted to go to Detroit. And this is the type of mentality I had. Let's move for the corporation, continue to pay your dues, and continue to ascend up the corporate ladder. 15 months after moving out to Michigan, they laid me off. So this was 2 companies, 2 layoffs. And I'm like, okay, the more and more I do this, why am I doing this? But in the back, what I didn't tell the people why I was getting laid off is my wife, my then girlfriend, now wife, I was planning to move back to New York City at the time to be with her. It was luck had it that, they just laid me off at the time when I was also trying to position myself to get another job. Got that other job. And we moved into Hoboken, New Jersey. I got a job up in Mahwah, New Jersey, which is 45 minutes away. So around that time, it was 2014, 2015, podcasts came out, or I got really big into podcasts.
Yep.
So instead of listening to sports, I was religious into fantasy football, just regular sports, listening to all that. I started to venture out thinking, okay, I'm starting to get a little more income. Where am I going to place that income that's not into a savings account? So first went into stocks, and then I'm like, let's branch out a little bit more. And started listening to bigger podcasts, started listening to this, whatever podcast that is centered around just investment types. I started to grow really interested in real estate. I'm like, wow, seems fairly simple of what you're trying to do. My wife and I, around that time, interest rates were 3.5, and we were like, all right, let's go find a place. We wanted to move closer to my parents, which are up in northern Massachusetts. And she is in Long Island. So we moved from Hoboken into Stamford. Put the 20% down, bought a condo with the plan to rent it out over once we moved out of our place. I was still commuting over to Mahwah, New Jersey from Stamford. So I had an hour and a half plus of commuting. And at this time, with all of the additional money that I had saved up, I started investing in stocks. And I just started to see the fluctuations that were occurring and the volatility that were in the stock market. Got much deeper into these alternative investments like real estate. And I got into, I tried figuring out what turnkey investments were, because I continued to want to ascend up the ladder of corporate America, even after getting laid off twice from these companies. Worked for Jaguar Land Rover North America and had a lot of interaction with the general partners or the dealer principals at these dealerships. And for those people who did not make money or who was not gifted the dealership, most of the people made money in real estate. So a bell went off in the back of my head going, okay, if these guys can do it, why can't I?
Right.
Instead of watching Netflix, when I got home at night, instead of watching the Detroit Tigers versus the Cleveland Indians, although I'm a Red Sox fan,
there you go.
I started paying more attention to just starting to read books and figuring out ways in which to buy single family homes or buy duplexes. And first wanted to do it in my local backyard and trying to buy stuff in Stamford. When I put 20% down on a house, I realized that all of my cash just went away. So I'm like, all right, let's figure out places that you can invest your money into something that has less of a down payment, so you don't have to save up that $50,000, $60,000, $70,000 for a down payment for your places in Stamford or Norwalk at the time.
Yep.
And while reading these books, listening to these podcasts, they told me to go to real estate meetups. These real estate meetups I went to, one of the first or second one I went to, this guy named Charles Dobbins, who's appeared at a few of them, talked about this thing called multifamily investing, raising other people's monies, buying businesses that are real estate, and then figuring this out. So this was the end of 2018 when I started to really deep dive into it. And it's been over the past 4 years, just trying to figure out ways in which I can continue to learn every single day how to better myself in multifamily. So yeah, I think that's a long-winded version of how I got to where I am today. It's really accelerated over the past 2 years. In the past 2 years, my business partners and myself have purchased 124 multifamily units in the Southeast, 53, soon to be 54, in Noonan, Georgia, which is 30 miles southwest of Atlanta. And then as of 3 months ago, we purchased a 70-unit apartment complex in Rock Hill, South Carolina, which is about 30 minutes south of Charlotte.
Congrats. Wow, that's awesome.
Congrats. That's huge.
Yeah. I appreciate that. Yeah. So I know that was a little bit long-winded, but that's how I got to where it is. And just those long drives, instead of listening to the same Red Hot Chili Peppers song or Led Zeppelin the entire way, I made sure that I started listening to real estate podcasts and figuring out ways to educate myself in the time that I was doing while driving back and forth to work.
Yeah. Well, you certainly weren't listening to Syracuse basketball games because, it's been a tough road. You're speaking to a guy who went to UConn and Rich and a guy who went to Villanova and me. So,
yeah, I shouldn't have brought that up. It's a little painful that what we're experiencing right now, but yeah, that's all I got.
Yeah.
Brendan, you mentioned that in these long drives, you're listening to podcasts and you had the courage to think about going big, right? A lot of people who are sitting in your position, me included, I started with single family flips because to your point about when it's thinking about the down payments and things of that nature, I was like, because I didn't come from a lot of money, I'm going to do a flip, I'm going to stack it, and then I'll use that profit to go buy something.
Yep.
What gave you the courage to say, you know what? I think that there is a better way. I don't have to do the single family route, or I don't have to do single family flips, but instead I'm going to look to raise money.
I'm a core believer in I'd rather fight a person who practices 1,000 kicks one time than a person who practices one kick 1,000 times. I knew my lane was multifamily. I know, like I mentioned, buying a business that is real estate related and trying to improve the net operating income and trying to improve efficiencies within the properties by lowering expenses, increasing revenue.
Right.
I just didn't want to spread myself too thin because multifamily in the grand scheme of it for me is very expansive of everything that you have to do on a daily basis. It's the marketing aspect, write newsletters, prospect deals, try to find money and finding partners that you can manage this together. I'm not born with a silver spoon in my mouth. I'd save every penny and I know where every penny is going to, but I just knew that was the quickest way for me to leverage money and figuring out ways to create more of it on the back end.
Excellent. And so when you go to create, well, let's talk about partners first. So it's one of the things that I've always been intrigued by in terms of how folks like us decide to partner and B, with whom to partner. So tell us how you met your partners.
First one that I met is local out of here as well. I met him at a real estate meetup in the area. It just wasn't CT RIA. This was January 2020 or December 2019. It's just a little fuzzy. And at this meetup, it's the networking and then go around talking in a circle. And, I'm Brendan. I'm an apartment syndicator. Rich is, I'm a single family flipper as a wholesaler, et cetera, et cetera. Right. So out of the group of 50 people, there were 2 people talking about syndications and what to do. Neither of us had our first deal, but the 2 of us were talking about it. And then it just something clicked. And we just kept in touch throughout the entire course of 2020. We were both looking at deals and trying to find something. He had his own business partner that he was working with, but he's the one he specializes on the acquisition side now. So over the course of 6 months of going back and forth of how to underwrite stuff based off of what we've read from books and from other operators, he brought me into his deal right around October 2020 that he got it under contract. And I met him through there, met his partner. And then since we didn't think we could bring in enough money to raise all the money, we just ventured out and started talking to other people who thought they could fill the gaps that we needed, i.e. the additional $1.5 million of equity that we needed to raise. We talked to key principals, and key principals, for those who don't know, are people who can essentially guarantee the loan, has a large enough balance sheet to be able to guarantee that, and which is required for most multifamily deals now.
Right. Excellent. As you started to identify the money partners, there's different kind of levels to the 506 rules, right? So are you doing a 506B? Are you advertising and do a 506C? Like, how do you approach the market?
Right now, the 2 deals are 506Bs. 506B is a family and friends raise. And we are asking everybody in our phone book, our mothers, our cousins, our aunts and uncles, if they want to invest $25,000+ into our deals. And for the first deal, I didn't flop entirely on my face, but it was a humbling experience trying to raise money from people and Rich, this will go back to the obstacles I had to overcome. I have very little real estate experience outside of, these few multifamily deals that I have. I've been a limited partner in other deals, but that doesn't necessarily evoke a lot of conviction from other people who are like, yeah, Brendan, I'm going to give you $25,000 of my funds because you think you can manage a multifamily deal.
Right.
Luckily, we had those other people who were able to bridge the gap. But yeah, so 506Bs, asking everybody in your phone book, telling everybody what I'm doing at every single event, and people start getting sick of me because all I talk about is real estate.
Yeah, I call it the 3-foot rule, right? If I'm consuming oxygen next to another human being who's also consuming oxygen, A, I strike up a conversation, and B, I find a way to talk about real estate in that conversation.
Yes.
Right. Oh, your kids are in nursery school? Oh, mine helped me invest in real estate, right? Blah, blah, blah. Right. So, yeah.
Brendan, as you go through this and you're thinking about raising money and talking to people, another one of the things that I think is really important for people to know is putting a team together. So you partnered with one person, you realized that they were really good at sourcing the deals or working on the acquisition side. I'm assuming you did an assessment of what your skill set was. How did you start to fill out the rest of the team and what you needed? And then when you went down south, what made you comfortable being in the markets that you chose?
To address the first question, the business partner is the sourcing and acquisition side. He also comes from a private equity background. So we were very comfortable with him being able to develop the business plan for our deals, for Rock Hill, for Noonan. And there were 6 of us on our first deal together. And most of us, 5 out of the 6 guys, this was our first syndication that we did. There was a need to help out our acquisitions guys doing like the day-to-day operations of the asset management. And that's where I have carved a little niche amongst the team right now. Then the rest of us, one of the guys, he runs a real estate podcast as well, based out of Baton Rouge. And his whole thing is just raising retail investment money. So that's where his core competency is. And what was the second part of the question, Rich?
The second part is, once you guys identified your market, like how did you build like a team on the ground there?
We just started, again, networking with people. We knew the markets we want to go into, which are the Carolinas and Georgia. There's great fundamentals behind them: economic growth, job growth, population growth, income growth. So we knew going into those metros that there should be some tailwinds at our back to be able to lift us forward with some of the demand that's going down there and raise up the rent growth. What we needed was to find the property management and construction team. So we vet probably 10 plus property managers prior to doing our first deal. And what really got us and sold us on the people that we now have as our third-party property management for both teams is we did a walkthrough during the due diligence period, just to be able to, they did it for us being in the Northeast. Not everybody was there, so we had a task rabbit there. Their team was the one who got out of their car and initiated a conversation with the other property management team, or the other property management team that we sat in their car the entire time. And they were 3/4 of the way done with the property tour by the time the second property manager actually stepped foot out of their car. They were a little pricier, but their background, their recommendations, their testimonials proved to us that these are the partners that we want. I wouldn't call us novices, but people who are just starting to break into the multifamily space, and making sure we're working with trusted partners to be able to execute on our business plan.
It's so important. And the point you just made is a big one, right? And that is that you don't necessarily want to hire the least expensive partner or contractor, right? Hiring mature, fully formed adults who are responsible and understand that they have your financial interests at heart. They have to have your back. It's worth spending a little more money on those folks because A, your stress level is going to be way down, and B, you're going to get better results, which is how they justify their slightly increased fees, right? Mm-hmm. As long as they're within the market.
As long as they're in the market. And one of our core philosophies is we're not here to squeeze out every single penny out of every single vendor that we work with. Right. We know at the end of the day that if we have good relationships with property management teams, and it may require us to pay an additional 1% over the other one, we're not going to have to go through the vetting and the brain dead process of trying to find a new one if we don't like those people. We did it right. We did our due diligence, not just on the property. We did it on the people that we're going to be working with as well, to make sure that those are the right ones to be able to help us to the promised land.
Right. And the thing is, do the math, right? If you're paying them an extra 1% on property management, which is based on the revenue of the building, mm-hmm. and they make your building or property 1% more valuable, which is not on revenue, it's on the value of the building, which is a much more significant number. It's an easy expense to justify to your investors, right? Couldn't agree more there, Brett.
Buying investment real estate is both thrilling and sometimes stressful. Without a lending expert by your side, most investors don't stand a chance. That's where CT REIA Funding comes in. CT REIA Funding was founded by investors to help investors just like you fund their deals. Whether you're buying a single-family rehab, an apartment building, or really any investment property, our team will understand your deal and help you close quickly. Go to ctreiafunding.com or call us at 860-876-0572.
So you've mentioned a couple of times books that you've read and podcasts you listen to. What's on your nightstand right now? I know leaders are readers, right? And so I'm just curious what you're reading these days.
Sure. I just finished The Alchemy of Finance by George Soros. I have another one of my books. I just finished George Soros, and I thought it was fantastic. He's one of the best money managers of our lifetime. So his ability to be able to change his thesis throughout macro and micro conditions is really something that I felt was really relevant to the time that we're in right now, with all the choppiness in the debt market and interest rates going from 3.5% just 3 months ago, a year ago, to now being 5.5%. We need to adjust our whole thesis as to how our underwriting and principles and theories to be able to test it out and see if it will truly work in today's place. Because we're still bullish on multifamily. We're just not going to be over levered going into it. We're taking a new approach, and that may peel back some potential returns, but it's going to, from a risk-adjusted return perspective, I think that's one of the best key principles that I learned as to protecting your wealth and making sure you're delivering upon what you're stating within your marketing materials. We're trying to do X to Y IRR. And right now, this, based off of everything you're seeing, we'd rather be more conservative and be in a good position in case we do hit a recession over the next 18 to 36 months.
When, not if, when, man, right?
Yeah.
Winter is coming.
I'm an eternal optimist.
Yeah, me too. But winter's coming. I'm also a realist. It's been a nice run for the last, 12 years, 13 years, and all things come to an end. It doesn't mean it drives off a cliff, but a 5 to 10% correction is healthy.
Mm-hmm.
And I think it has to happen at some point, right?
And this is where, back to that 5 to 10% correction is why we're going in with being under levered in some of our deals.
Right on.
I think just to be safe, and our model too, I'll promote our business as well. We're not here to do a 2 to 3 year flip on a multifamily deal. What I really am attracted by is you buy real estate and then you wait. And if you can buy it on a good basis with good debt and fix it for 10 years, 15 years of fixed debt, you have a better chance to be able to operate within a vacuum. And once you get your business plan, be able to sell it when the opportunity is right and not have to force your sale of the property.
Yeah. I mean, as you look to hold an asset for 5, 7, 10 plus years, two really cool things happen, right? One is your expenses, particularly your debt expense, stays stable, which is a beautiful thing. You can manage your expenses within a point or two of inflation, right? But your revenue can go up 2, 3, 4, 5% a year. So you start to create a spread between what your expenses are and what your revenue is. And as we all know, we've talked about it here on the show quite a bit with several. NOI is a beautiful thing in commercial real estate because the bigger NOI, and you said it earlier, you're buying a business, you're not buying a house. It's an entirely different value exchange. And so larger NOI means a significantly higher price. And if you do it right in the beginning and you don't get over leveraged, and you think through all the contingencies. I talked to our team here at Clark Street about projecting mushroom clouds on the horizon and plan for that, right? It's the Irish. Right. When they don't arrive, you're pleasantly surprised and you tend to be a little more profitable as well. So you can deliver on your promises and then some to your investors.
So Brendan, going back to the money that you've raised and the investors you guys have brought on board, how do you guys handle the communication process? So you're talking about looking out into the horizon, you see some storm clouds ahead. How do you prepare your investors to say, hey guys, initially I'm making this up, but we promised a 20% IRR. From what we see, we may have to change. It's going to be 15% or whatever that is. How do you manage that process?
We have a monthly investor report that we send out to every single one who invests in our deals. So if you're investing in our Noonan deal, you get a monthly report on our Noonan performance. If you're part of our Rock Hill deal, you get a monthly report based off of what's going on at the property. We're approaching our refinance for our Noonan deal right now. We bought that February 2021. We're almost 100% stabilized, just waiting to finish up an office conversion on that property. But we have all the paperwork ready, and we've started to send out our underwriting with our debt brokers to the market. For the people who invest in these as a limited partner, they understand some of the macro things that are going on. So if you're seeing interest rates going up by 200 bips, they know at the end of the day that could turn your 20% IRR down to 15 or 16% IRR. But we're communicating that to them. And we underwrite to this as well. So we have different models and we run our property through different models. Like, okay, here's what it does if interest rates remain flat. Here's what happens if interest rates go up. So we make sure to prepare for it. And when we buy our properties, like I said, we're properly levered and we're making sure that we're not going above our basis for what things used to trade for. We're not underwriting we are underwriting green lights, but those are numbers we're not promoting in our pro forma or offering memorandum. We're putting stuff that like you're taking out I'm a golfer in my spare time when children aren't running around and all of that and not doing real estate, but I'm making sure I'm hitting into the fairway and making sure I can survive an extra. I'm not taking out my driver on a 200-yard par 3 and hopefully getting onto the next hole type of thing. So I'm not promoting 20% IRR on my deals. What I'm doing is we're promoting 12 to 16% right now IRR. And I think people understand that because of what they're seeing, not just what they're seeing in the debt market, but you're also seeing in equities now as well. And I think like the S&P 500 as of yesterday is below what it was 15 months ago. So you get a level set expectations with people. If you want to invest with an operator who's telling you they're going to get a 20% IRR or 20+% IRR, you better hope they're an experienced developer. But if you're doing multifamily syndications and you're a good operator in the market, you just need a level set. It's a 12 to 16% is our underwriting, and that's what we're submitting an offer to. Right. If rents go $50 above, $100 above, we have our target IRR, which should be able to deliver better returns for you. But we're not promoting those because we like to sleep at night and make sure that we have a fiduciary responsibility to our investors to be able to say, if you invest with us, we're going to protect your wealth while also growing it. And then what we're doing is making sure that we can achieve our business plan and not overstepping it. And that's where I liken it to my experience working in for Fortune 500 companies.
Right.
You can't overpromise stuff and then expect to deliver upon this without hurting other people. It's one of those things. It's, you got to be realistic, and the times are telling us to be much more realistic, be more conservative, and to be able to find assets that still perform. Or if they're not performing, making sure you have a good business plan in place to make sure it performs and then hit upon your numbers.
Yeah, exactly. It's, the old axiom, promise little and deliver much, right? You want to be responsible, and you certainly want to be positive because there's a lot of upside in a lot of these deals, right? But you also need to manage expectations well and manage to your investors' expectations. And if you hit a home run, fantastic, but singles and doubles add up too, right?
Yeah, exactly.
So let me ask you, when you're not talking about real estate and not chasing your toddlers around, and I don't know how you do this, I'm going to ask you this offline, but when you're not playing golf, because I have a beautiful set of golf clubs I haven't seen in, probably until after my little one graduates from college. What else do you like to do?
I don't golf. I just like to golf.
Yeah. Fair point.
Spend time with family and exercise. I make sure to carve out at least 30 minutes of my day to stay in shape and go run outside. Try to do that earlier today when the kids are at daycare. But it's reading, exercise, spending time with family, and real estate takes up most of it. And I think it's one of those things with, I have a 9-to-5 and I do well with my 9-to-5 and my 5 to 9. I love my 5 to 9. So I'm just, most of my time trying to grow my own real estate business that's where most of it's consumed. But making sure I carve out time with my family, my 2 boys and my wife are what's most important to me, because that is my why.
Excellent.
So let me ask, do you have aspirations of letting go of the 9-to-5 at some point, or do you think you'll always be a 2 passion guy?
Hopefully nobody from my work listens to this. So that's the plan. It's just one of those things. I want to retire my wife before I go from the business world. But yeah, if all goes well, hopefully within the next 18 to 36 months. The when that we were just discussing on the recession, I'd rather, knowing that that's coming, I think that's going to lean later to 36 months. But hey, it's a good goal for me to have. And that's before I turn 40. So yeah, no, it's there. The drive is there every single day. I write it down on my whiteboard. I write down my goals every single day, and that's one of them for as soon as possible. But making sure my house is in order before I do so.
Amen. Yeah, a friend of mine told me, he was an accountant actually, told me that before I ever considered going full time, I should have a year's worth of living expenses tucked away somewhere that I break glass in case of emergency kind of thing, right?
Yeah. And unfortunately, in real estate, you're not too liquid. So I got to make sure to put that aside to be able to do so.
Yeah.
If you were talking to 23-year-old Brendan, what kind of advice would you give to him or to other listeners listening to this podcast and they're thinking, what should I do to get started, or how do I go about getting started?
Accept failure.
Yes.
Nothing is easy. I believe the word fail is your first attempt in learning. So just do it. Phil Knight's, what he did best with Michael Jordan, take that first step and get into it. For other people who are listening, build your own corporate ladder. I tried to ascend it throughout my 20s and it got me laid off twice. I feel like I'm just a digit for these large corporations and they can replace me at any single time. So know your worth and just get out into the unknown and experience it. You don't need to hit a home run on your first deal. You don't need a 20% IRR. What you need to do is make sure that you're in the game and you're still doing what you need to do, because it can bite you in the butt real quick. I know that once you start accepting other people's money, that you need to be able to deliver upon your returns, because the second start-ish hits the fan, they're not going to trust you again. And I want to make sure these are repeat investors that I have for them. I know that's long-winded of what I should have told my 23-year-old self, but just do it. It's a great world out here and it's a fun game. It's a tangible asset and you can make things beautiful.
Yeah, it's something to be said for being able to go out and touch the asset and actually physically be able to affect to the positive its value, right?
Right.
If people want to get a hold of you or learn more about you or your business, what's the best way for them to get a hold of you?
Sure. Email me, brendan@bkcholding.com. That's the best way to do it. Hopefully we can send it over in the show notes. A couple of websites as well. I'm on your Instagram, Facebook, LinkedIn. Please friend me. I love these type of conversations. Anytime I can get two other people or just one other person who wants to listen to me talk about real estate and they're not walking away from me 30 seconds after I start the conversation is great. Is a great person to have a conversation with.
Absolutely. Absolutely. Well, Brendan, thank you so much for your time today. It's a pleasure to finally meet you. And at some point in the next 2 weeks, we're going to end up having a beer together too. So
I hope so. Excellent.
Yeah. All right. Thank you so much.
Mr. Brown, thank you, sir. And
thank you, Mr. Matthews.
I appreciate it. And once again, this is Real Estate Underground. Thanks for listening, and we'll see you soon.
This has been the Real Estate Underground podcast, a CT RIA presentation. Don't forget to rate, subscribe, and share this podcast with your friends. If there's a specific topic you want us to cover, post it in the comments. For more information on the Real Estate Underground podcast or CT RIA, go to realestateundergroundpodcast.com or ctria.com. Until next time, happy investing.